Welcome to the Deep Dive, custom tailored for you, where we cut through the noise of earnings calls to bring you the essential insights. Today, we're digging into Pediatrix Medical Group's Q2 2025 earnings call. This one was from August 5th, and it's a quarter that has definitely turned some heads and really rallied investors.
Yeah.
But, in this healthcare landscape, it's always complex, lots of headwinds. So we got to ask, is this just a temporary bounce, or has Pediatrix actually found a way to kind of sustain this outperformance?
Yeah, it was a quarter that absolutely grabbed the market's attention. I mean, really significant outperformance and a confident outlook too, which wasn't just, talk. It really did fuel a substantial rally in the stock. Might be signaling a real turning point for them.
Okay, so let's unpack this for you. Pediatrix is a major national player, right? Critical care services, especially strong in neonatology, so caring for newborns, particularly the ones who are ill or premature. They posted some really compelling numbers, and these might highlight a shift, and maybe a fundamental shift, in how they're operating. What we're seeing here, it doesn't feel like just small tweaks. It seems like, strategic optimization across the board. Let's jump right into those headline numbers for Q2 2025, because honestly, they are undeniably strong. Pediatrix reported GAAP EPS, that's your standard accountings per share, of $0.46. But maybe more telling for their core ongoing business, their non-GAAP or adjusted EPS. That often gives you a clear operational picture, stripping out one-offs. It hit a really robust $1.53. Now, just to give you some context, that absolutely smashed consensus expectations, beat them by about 26%.
And it wasn't just the earnings, right? Revenue also came in strong, somewhere between $468.8 and $469.0 million, also beating expectations. Now, what's interesting here, while the reported revenue actually saw a 7.0% drop year over year.
Yeah, that sounds bad initially.
Right, but it was mostly because they strategically sold off some parts of the business, these divestitures. The underlying health, the strength of the business they kept was crystal clear. Same unit revenue, so looking at the operations they've held on to consistently, that grew by an impressive 6.4%. So that tells you they're pruning strategically, not just shrinking, aiming for long-term health.
Okay, and here's where it gets really interesting for me, and I think for you too, because these numbers, they just speak volumes about efficiency. Adjusted EBITDA earnings before interest, taxes, depreciation, amortization, it's that common proxy for operating profit, hit $73.2 million. Now, that is a significant jump from $58 million the year before. And the cash flow. Operating cash flow is also really strong, $138.1 million, up from $109 million, left them with a nice cushion. $224.7 million in cash on hand. Total debt's around $606 million, no revolver borrowings. Their net leverage is just over 1.5 times. That's using the midpoint of their updated full year 25 adjusted EBITDA outlook.
Yeah, and that 1.5 times net leverage, that's a critical detail, really highlights their financial discipline. I mean, for context, lots of companies in healthcare operate with much higher leverage ratios, so 1.5x, remarkably healthy, very manageable. And operationally, you saw the metrics really backing this up. NICU days were up a strong 6% year over year. That's a crucial indicator, right? Shows more infant days in neonatal intensive care units, drives their volume. Yeah. Plus, same unit volume overall increased by 2.9%. And reimbursement mix and pricing saw a 3.5% improvement, even their DSO day sales. Outstanding.
How fast they collect their bills.
Exactly. That improved too. Dropped over 3 days year over year to 46.4 days. So better cash collections, tighter revenue cycle.
And the confidence, it didn't stop with just the results. Yeah. That's a powerful signal to the market always. Management raised their full year 2025 adjusted EBITDA guidance. They tightened the range and raised it to $255 million. That's a nice bump from the previous $240 million. When management does that, tightens and raises, it's not just, optimism, it's conviction. They believe in their performance.
Exactly. And just to sort of punctuate that confidence, they announced a new $250 million share repurchase authorization that came after the call on August 18th. That's an explicit way to return capital, tells us they think their stock is undervalued, and crucially, that they have enough cash to give back to shareholders, not just plow everything into new growth right now.
Okay, so those are the numbers. Pretty impressive. But let's go a bit deeper. Beyond the metrics, what's really driving this turnaround? What can we learn from how they're doing this? This strong performance, it wasn't accidental, right? Highly intentional. Management pointed to a few key things. Continuing high patient volumes in neonatology, that's their core business. A stable payer mix, so a good blend of insurance types paying reliably, and just disciplined operational management. That 6% increase in NICU days, plus higher patient acuity, meaning sicker babies needing more care, that really underscores how resilient their core business is. I mean, it's hard to think of a more essential service.
And what's really insightful, I think, isn't just that these individual levers are strong. It's how Pediatrix seems to be pulling all of them quite aggressively at the same time. Take that 3.5% same unit reimbursement and pricing growth. That got a big boost from strong revenue cycle management, RCM cash collections, and also an increase in hospital administrative fees.
RCM, that's basically how they handle billing and getting paid, right?
Yeah.
Making sure it's accurate and quick.
Precisely. And those administrative fees alone, they made up about a third of their pricing growth in Q2. Now, this isn't just about sending bills out better. It really speaks to their improved negotiation power and the value hospitals see them bringing. In an environment where providers often feel squeezed, getting a 3.5% pricing bump, that's a serious achievement. Suggests a stronger position.
Yeah, and management stressed these fees weren't just handed over. They made deliberate efforts, they said, to strengthen those hospital relationships, to clearly show the unique value and expertise they offer, which justifies asking for those administrative fees. It's smart, long game stuff. Plus, they brought in Greg Neeb. He's a longtime colleague of the CEO, Mark Orden. Brought him in specifically to improve operations, find financial and operational opportunities. That kind of targeted hiring shows a real commitment to optimizing from within.
And that strategic portfolio restructuring you mentioned earlier, selling off practices, absolutely pivotal. Think of it like an athlete shedding unnecessary weight to get faster, perform better. Yeah, it trimmed the headline revenue number, but these moves clearly improved the quality of their earnings. How? By reducing practice salaries and benefits year over year. Even the restructuring costs in Q2, about $3.8 million. Those were tied to RCM transition and some staff reductions. Again, shows a clear strategic focus on streamlining and improving their cost base. This isn't just hacking away costs, it's smart, deliberate refinement. So looking ahead, management expects that full-year adjusted EBITDA to be fairly ratable across Q3 and Q4, meaning pretty consistent quarter to quarter, even though they'll face tougher comparisons from growth they saw late in 2024. They think margins will stay fairly stable, and they project ending the year with $350–400 million in cash, assuming no other major activities, of course. So it paints this picture of controlled growth, sustained financial health.
Which brings up a really important question for you listening and for us. How is Pediatrix managing the broader healthcare environment? Because it is turbulent. CEO Mark Orden specifically talked about what's sometimes called the Big Beautiful Bill, a nod to the Inflation Reduction Act's healthcare parts. He sounded pretty confident about managing its effects. Said it phases in over time. It impacts expansion versus non-expansion states differently, and about 60% of Pediatrix's volume is in non-expansion states. And it specifically targets expectant mothers, which obviously lines up perfectly with their core focus. They're not just reacting, they're looking at the details. Right. And speaking of being proactive on policy, they're also actively lobbying for the extension of those premium tax credits, the ones set to expire at year end. That directly affects patient affordability, access, and ultimately their business. Shows they're looking ahead, trying to shape things. And on the No Surprises Act, that's the federal law about unexpected medical bills from out-of-network docs.
A tricky one for many providers.
Yeah, but Pediatrix said they've actually seen positive outcomes in arbitration. They've maintained an overwhelmingly in-network status, suggests they've navigated that pretty tricky regulation successfully, avoiding big costly fights and keeping patient trust. Okay, now let's talk investor perspective. Because the March reaction to this quarter, undeniably bullish, and you can see why. Shares jumped 8.4% pre-market on the day, closed up 5.0% on August 5th, then rallied another 11.8% the next day, August 6th. And trading volume was way up. Fast forward to mid-September, September 16th, Pediatrix stock, ticker MD, is trading around $16.57, reflecting some really impressive returns, up 4.3% in a month, nearly 19% in 3 months, and over 52% in the past year. That kind of sustained climb isn't something you see every day.
No, it's not. And this positive feeling, it does line up with some broader tailwinds in the sector. Things like hospital labor costs normalizing, stable payer mix, helping provider groups generally. We've also seen investors rotating into healthcare. You saw big inflows into the healthcare select sector as PDR ETF, the XLV in Q2. But what makes Pediatrix stand out, I think, is they aren't just riding these trends. They seem to be actively amplifying the benefits through their own specific targeted improvements, creating a real advantage even within a sector that's doing well. This strong performance, the raised guidance, it really shifts the narrative for Pediatrix, moves them from just repairing the business, stabilizing things, to now measured reinvestment.
With neonatology leading the way again as a growth engine, it's quite a transformation story unfolding.
That shift, repair to reinvestment, that's really the core takeaway for you, I think. So key things to watch going forward. Well,
Their quarterly performance against that higher EBITDA guidance, obviously, continued stability in those NICU volumes and the payer mix. The pace of any more portfolio pruning, are they done selling off assets, or is there more optimization coming? And really crucially, how they plan to use that new $250 million share buyback program. How fast do they execute? What impact does it have on shareholder value? Lots to keep an eye on.
So when you put it all together, the financials, the strategic moves, the market reaction, it leads us to a pretty interesting thought experiment for you, our listener. Now, remember, this is absolutely not financial advice, but how might someone think about constructing an investment thesis around a company showing this kind of specific internal strength?
Right. This is the deep dive, and it's time for our This Is Not Financial Advice segment.
Okay, so given Pediatrix's strong Q2, the raised guidance, solid cash position, low leverage, there's definitely a compelling story here for sustained outperformance. We know investors have been moving into healthcare. Pediatrix has already had a great run. So here's an idea for the committee of one that's you, listening right now. Maybe consider a pair trade. Long Pediatrix, MD, and short the iShares U.S. Healthcare Providers ETF, IHF.
Okay, let's unpack the rationale there. The idea is Pediatrix's core neonatology business is showing unique resilience, driven by things like rising patient acuity, that stable payer mix, plus their aggressive work on RCM and negotiating those hospital admin fees. Management seems clearly opportunistic, looking for growth, especially with those hub-and-spoke hospital systems, even in this turbulent environment.
Right.
And they're backed by a strong balance sheet and that new share repurchase plan. It's really a story of internal strength meeting external opportunity. So the bet here, just for your consideration, is that Pediatrix's specific niche, its focused operational wins like the RCM gains, the smart divestitures, and its options for deploying capital, like that buyback, that these will let it continue to outperform the broader healthcare provider sector. That broader sector, maybe represented by an ETF like IHF, might be cooling off a bit after recent gains, or might face more general headwinds that Pediatrix, because of its specialized focus in sharp management, seems better insulated from. So it's really a conviction play, right? Betting on specific idiosyncratic strength against maybe a more generalized sector sentiment, betting on the specific versus the broad. And that wraps up our deep dive into Pediatrix Medical Group's Q2 2025 earnings call.
Yeah, a truly impressive quarter. You saw strong operational execution, a confident management team, and what looks like a clear strategic path forward, especially in their core, absolutely essential neonatology services. It really suggests a company that's moved beyond just surviving, hasn't it? Seems like they're actively thriving through strategic design.
And as always, for you, our listener, while we've been dissecting potential strategies and insights here, please remember, this deep dive is strictly for educational purposes. It should definitely not be taken as financial advice. We always encourage you to do your own thorough due diligence, your own independent research, and maybe talk with a qualified financial advisor before making any investment decisions.
Absolutely. Thank you for joining us on the deep dive. We really appreciate you tuning in, and we look forward to bringing you more insights from the world of corporate earnings and beyond next time. Keep asking those tough questions. That's where the real understanding comes from.